Let's look at other types of long-term liabilities that a company might have. Typically those would be other types of long-term notes payable. Those would be liabilities that exceed the current year, and or mortgage notes payable. Now when I say mortgage, I just mean it's secured by a specific asset. So we tend to think personally of a mortgage as something you have on your house. Well, a house is a type of asset, and that loan is secured with that asset. So if you default on your loan, then the bank takes the house. Very similar for a business. And let's take a look at what those payments typically look like. So what happens is you usually have an even payment, so you will make the same amount of payments. This is kind of an odd graph because it's saying you're making a once a year payment. Most of us will make monthly payments on our house or auto loans, but we make the same amount every single month or for every payment. And what happens is initially a lot of that payment goes to interest, and with every payment that you make, a little bit less will go to interest and a little bit more will go to the principal, which is illustrated here in the purple. So if you actually make a little bit extra payment, you can see then the next month a little bit more will go to your principal and a little bit less will go to your interest. So you end up paying off that loan a little bit earlier. The other thing people do is they squeeze in an extra payment somewhere, and again that has the same effect. Every time you pay a little bit more or a little bit extra, a little bit less will go to your interest and a little bit more to your principal. Here's another graph which doesn't illustrate how most payments are made. I won't spend a lot of time on it. This is just saying that we would make an equal principal payment over the life of the loan, so our payments will go down every month, and that's typically not the way most loans are handled. This is a really good schedule as well. It shows you how the amount of interest and principal is calculated for each and every payment. So you start out here with column D, which would be your principal balance. That would be the amount of money that you borrowed. And then you would figure in what your payment amount is. That's given to you by the bank. You can also calculate that on your own using Excel or a financial calculator. So you get your principal balance and you multiply that times the actual interest rate. Now this is an annual rate, so if you were paying it for a month, you would have to multiply that times the length of time, the number of days that were actually outstanding between payments to calculate the interest expense. So then what you do is you take your cash payment amount, in this case $33,231, minus the interest amount, and it shows you how much actually goes to reduce the principal. For this first payment, $3,231 went, so that would be subtracted from our initial principal to get our new principal. That would be the amount that we actually multiply now times the interest rate. So you can see that the amount that goes to interest in the second payment is a little bit less than in the first payment. Here's where you can also see, well, what if I made $35,000 payment instead of $33,231? Well, the same amount would go to interest, but a little bit more would go to your principal, which means that this D would be even less, so the next time my interest would be even lower. And I did work for a company my first job out of college, and we, this was back in the 90s, and we actually did a schedule like this for our customers. So every time they would send in a payment, we would calculate the interest in their new principal balance. So you can certainly do that and see. It's called an amortization schedule. You could actually take it out for 30 years or whatever using Excel and find out, well, what if I make an extra payment or a little bit extra on my principal? And just real quickly back to the accounting of notes payable. Very simple entry when we actually get the note. We debit cash for the amount, credit mortgage notes payable, and then, and then that first interest payment, you can see the interest expense out of that $33,231 payment was $30,000. The principal reduction, the amount we reduced, was $3,231. So that will be a debit to mortgage notes payable and then a credit to cash. Just a couple other things about notes. If you do go seeking a auto or a home loan, make sure you have a loan that's simple interest, which is what these are based on, and no prepayment penalty. Those are two biggies that you want to watch out for. I've had a loan or a couple of loans before that did have prepayment problem, or couldn't pay them off early, which is always an issue for me. And if you get the money or you find a more attractive loan and you want to switch it out, you want to make sure you don't have those prepayment penalties. And there are other types of loans besides simple interest, so you really want to stick to simple interest. Those are the least confusing and the most straightforward. There's some fuzzier types of loans out there, pre-computed and other kinds that front load the interest that you don't want to be associated with either. Thank you.